So Alibaba's earnings actually fell by 96%. So no point starting off this video by saying that, oh, the market might be overreacting. Because as long-time shareholders, this is probably nothing new. But anyway, as the market closed yesterday, Alibaba was actually down 6%, while on the contrary, interestingly enough, another Chinese big tech also reported earnings on the same day. And Tencent, with the OTC, over-the-counter ticker, is actually up 4.7%. So in this video, we will dive deeper into understanding Alibaba's most recent earnings. And also, I just maybe want to apologize that this entire analysis video might be a little bit haphazard, and I'm basically analyzing on the go, so just keep that in mind. Anyway, these are just some of the few key highlights that I extracted. So Eddie, who's the new CEO, has came out and said that our strategies are returning to growth, and both the China and international commerce business actually realized a double-digit year-on-year GMV growth. So in terms of how he understands Alibaba as a business returning to growth, Taobao and Tmall on the top line has grew revenue by 4%, cloud segment has grew by 3%, the international commerce section has grew by 45%, and Cainiao, which is the delivery platform, has grew by 30%. And one important metric that many long-time shareholders are looking forward to is essentially how they're intending to reward shareholders. So in this time round, in the earnings presentation deck, they actually presented a slide additional on top of their normal disclosures on their share buyback program. So in the fiscal year of 2024, they essentially repurchased a total of $12.5 billion of shares, and they basically retired 5.1% of their shares outstanding. On top of that, they actually declared dividend, which is $1 per share, as we have received last year. That's around a 1.25% yield. And on top of that, they additionally declared a special dividend of 66 cents per share. And if you add them up together, that's roughly around a 2% yield on the current market price of $80 per share. And especially so when the share price is not appreciating by any extent, this is basically the best that they can do. Buying back shares at a cheap valuation. On top of that, just give you special bonus dividends from time to time, and to continue growing that dividend income stream. Now, in terms of the net income, as you can see on the top line of a negative 96%, why did it fall so much? Largely speaking, it's because of the net loss from investments in their publicly traded investment portfolio. And as you know, Alibaba as a business, they also have an investment arm that basically strategically invests in. Last year, it was actually net accretive, where it added around 10.5 billion renminbi to their bottom line. But this year, it was actually a negative 5.8 billion. So if you add up the delta, it's actually 16.3 billion. And the operating income was 14.7 billion at the top. And if you deduct away this 16 billion, that's where you see this 90+% drop. But that said, I think if we were to just focus onto the core business of Alibaba, and you just look into their operating income, 14.7 billion RMB, that's still a negative 3% year-on-year. But if you pull it out on a trailing 12-month basis, they're up 13% year-on-year to 113 billion renminbi. So cash flow from operations also took a hit at a negative 10% year-on-year, and they are stepping up their capex, basically their purchase of plant property equipment, etc., by 5 times of that figure to around 10 billion RMB. But on a trailing 12-month basis, they still delivered a very strong free cash flow profile of around $21 billion, US dollars here in this case. So their cost structure remained relatively flat, and their share-based compensation is also coming down, negative 6% year-on-year. So they're still being very tight in terms of their cost control and how they manage their expenses. So in terms of their balance sheet, it's still the same number. It's still at a very pristine condition. They have 85 billion US dollars on their balance sheet right now, cash and cash equivalent. If you net out the debt, their net cash is at 62 billion. So the market cap is at around 190 billion. If you net out the cash, that's around 128 billion in terms of their enterprise value. So using a 128 billion enterprise value and a 20 billion free cash flow, Baba is basically trading at a 15.6% free cash flow yield. I know a lot of people are saying that yes, everybody, Tom, Dick and Harry, even my mother knows that Alibaba is cheap. So for those of you who are looking to consolidate your investment holdings onto one platform, I think you are in luck. So right now, until the end of May 2024, Weibo has a shares transfer-in campaign that allows both new and also existing users who have not transferred shares to Weibo to get up to $150 US in transfer out fee subsidy on top of cash vouchers, which can worth potentially up to $2,000 US. and exclusive $500 worth of trading vouchers. So you can qualify for this campaign by just transferring 10,000 US dollars worth of shares and maintaining it for 90 days to receive 400 US dollars worth of cash vouchers. And to get rewards from Weibo's share transfer in campaign, you just have to follow 3 simple steps. So step 1, go down to the link below, click on participate now, create an account if you haven't done so, and fill out the share transfer in request in the app. So step 2, initiate a share transfer in before 31st of May and complete the transfer before the 5th of July. So once you complete the shares transfer in that meets the requirements, you can submit the transfer out fee proof to get the subsidy. And step number 3, meet the following requirements during the holding period and you can get to claim the rewards from the My Rewards page during the stipulated time. So it's as simple as that. Don't waste any more time. You can sign up for a Weibo account in the link down below and enjoy all the perks today. Just focus on 3 business verticals: Taobao, Tmall, Cloud and International. So for Taobao and Tmall, they said that the price competitiveness and the focus on user experience allowed them to appreciate this double-digit GMV growth. And on top of that, there's also an increase in the number of purchases and purchase frequency. I think firstly, yes, everything sounds fine and dandy because double-digit GMV sounds interesting and exciting. It means that, oh, maybe the growth phase of Alibaba is back. But that's it. I think one important context that's missing here is that actually broad-based market sentiments-wise, China Q1 retail sales actually grew by 12%. So it just means that they might just grow in line rather than trying to outperform, meaning they're not grabbing market share and it doesn't seem like Alibaba is also losing market share. So they're in a pretty stagnant or at least in a competitive space right now. I think one bright spark here is that the 88 VIP, which is the prime equivalent of Amazon, actually increased double digits and they have more than 35 million users during this quarter. I think this is an important pie to continue looking forward to because it basically means that these 35 million shoppers are very loyal customers to the entire Taobao ecosystem. Very much similar to the 100+ million Prime members on the Amazon ecosystem. And on the flip side, in terms of the CMR, which is the customer management revenue, and basically most of the advertising dollars and their take rate that they levy on most of these merchants, there's a decrease in take rate due to more contributions from Taobao, which is the cheaper alternative compared to Tmall. And they're currently experimenting and testing with a new model with rather weak monetization. So that's generally the e-commerce platform. So if you zoom out and look at it from a bigger picture perspective, it seems like they are essentially maintaining their competitiveness. They're not necessarily breaking more grounds in terms of their investments in UX, making it more competitive, their architecture, etc, etc. It's probably all still work in progress. Now, moving on to Cloud, it's still pretty weak. It's up only 3% year-on-year in terms of their revenue. They did go back to the same idea where they said that they want to focus on high-quality revenue, reducing many of these low-margin project-based contracts. But that said, I think many investors are still very disappointed with the low growth rate and uninspiring profitability. I understand that they want to move out and try to focus more in terms of the high-margin, high-quality revenues, but it's not necessarily showing much results. However, I do like the idea that they are passing on cost efficiencies and savings downstream to their customers. But that said, I do think that this migration to the cloud or basically cloud storage should be a commodity business. So many of these tech companies, whether it's Tencent Cloud, Ali Cloud, whoever that is offering many of these products, they should focus on value addition and integration, using many of their tools, analytics, etc, and don't just focus on migrating people onto the cloud. People will want to see what kind of value you can add to their business and to achieve business outcomes. So the AI related revenue should be the focus, and they did disclose that it was a triple-digit growth. I do think that it's a very small base. We need more time to basically test out this thesis on whether their AI enabled tools and analytics are really benefiting many of these businesses, and it becomes a very strong recurring income. Now, to their international arm, they did grow very spectacularly. They grew 45% year-on-year, mostly from retail, which is plus 60% year-on-year. They did also say that their combined orders actually grew 20% year-on-year. So the growth was contributed mainly by choice on AliExpress. Personally, I don't really put a lot of emphasis on the international arm. I still focus on core commerce and cloud, but that's it. To me, everything else is a core option because I'm essentially just betting on China's core commerce, which is Taobao and Tmall, continuously executing and being able to revert back to growth and to sustain their market share. And just that alone, they're able to print the cash profits and cash flow and return it back to shareholders. So I think just some closing thoughts in terms of the consumption pattern of broader China. China's Q1 retail sales actually grew by 12%. It's in line with consumption recovery, and we can see that this story is slowly playing out. So I do foresee this recovery as China continues to execute their policy tweaking, whatever stimulus that they want to do. But that said, I think circling back to Alibaba, the double-digit year-on-year GMV growth is not necessarily an Alibaba-led initiative. So there was this interesting comment that I recently came across, saying that Alibaba has become such a pivotal backer of AI startups in China that industry insiders have started to joke, saying that if you want to invest in China AI, just buy Alibaba stock. It's a China AI ETF. And it's said by one manager at an Alibaba-backed AI startup. So I think you just have to kind of know there's still kind of two key factors here. Number one, know the incentive structure. Know the person is inherently biased. So he is backed by Alibaba. So whether is Alibaba really a China AI ETF, I think it's up to your own discretion and your own judgment. But secondly, I have to kind of concur the idea that this is generally the climate in China. In the earlier years, I think at least over the last decade or so, there was this term in China called BAT, which is the Chinese tech giants, Baidu, Alibaba and Tencent. So these three basically monopolized the entire consumer tech or Chinese internet industry. And they basically just want an exposure in the entire ecosystem. I don't think it's necessarily different. Yes, I do agree that there might be more players in the system, comparing maybe ByteDance, JD, Xiaomi. Many of these smaller ones or up and rising tech companies are also rivaling. So it just means that there are more opportunities out there and it becomes a little bit more crowded in the space. But many of this promising and popular deal flow still flows to many of these big tech giants. Now, I think focusing back on the Baba story, the losing market share theory is still kind of intact, but they are basically in the stagnation phase. They're trying to compete their way back into it. The business is still undergoing some sort of transition. There are still a lot of competitive pressures coming in. You are still buying a cash printing machine, which is priced for basically no improvements going forward. Because if you were to just pull an Excel sheet, just punch in any numbers, just punch in a 0% growth rate, the valuations today is still cheap. So that's how ridiculous it gets. So upside might seem murky depending on the execution, but the downside is still rather limited. I say that when you look into Alibaba today as an investment opportunity, if you hold it long enough, I don't necessarily think that there's a huge room for you to basically have permanent loss of capital. Especially so with the amount of buybacks that they're focusing and the dividend floor that they basically put on the share price itself. And of course, there'll be a part 2 where I'll be talking about Tencent's most recent earnings, which is also my second largest position. So the earnings was pretty interesting. To me, when I compare both companies, which is Tencent and Baba, they are in rather similar plight. They're in the same geographic region. They're both big tech companies. The quality of the business and the valuations might be different, but they're operating in the same assumptions and the same boundaries, as many people like to put it, because they are fearful of the China risk, etc., etc. But to me, when I look at how these two companies perform and how they deliver their earnings and their business results, etc., it seems to me that it was never about regulations or China risk. It was just an argument for the sake of it. So China risk is just part of story building, but it has a compounding effect and it's very scary. So with that, I hope you guys enjoyed the discussion and we'll see you in the next video. Goodbye!